What gift tax rules apply to non-U.S. citizens? Have you ever wondered how gift tax rules work for non-U.S. citizens? It can be quite different from what U.S. citizens experience. Let's break it down. Non-resident non-citizens are only subject to U.S. gift tax on certain types of property. This typically includes tangible property located in the United States, like real estate or physical assets. However, intangible property, such as stocks or bonds, is usually not taxed when gifted by non-resident non-citizens, with some exceptions. This is a major difference from U.S. citizens, who are taxed on their worldwide assets. Now, let's talk about the annual gift tax exclusion. For 2025, the exclusion amount for gifts to individuals other than a spouse is $19,000. This means you can gift up to this amount per person without it being considered taxable. But when the recipient is a non-U.S. citizen spouse, a higher exclusion applies. In 2025, this special exclusion is $190,000. This is much higher than the standard exclusion, but it is still limited compared to the unlimited marital deduction available for U.S. citizen spouses. When it comes to gifts to non-citizen spouses, things get a bit tricky. Unlike gifts to U.S. citizen spouses, which have no limit, gifts to non-U.S. citizen spouses are capped at that $190,000 exclusion. If you give more than this amount, the excess is taxable. For example, if a U.S. citizen gifts $250,000 to a non-U.S. citizen spouse in 2025, $190,000 is excluded, leaving $60,000 that is taxable. Now, if you make taxable gifts of U.S.-situated property, you must file Form 709, the United States Gift and Generation Skipping Transfer Tax Return. This applies if you make gifts of future interests, gifts to any donee other than a spouse that exceed the annual exclusion amount, or outright gifts to a non-U.S. citizen spouse that exceed the special exclusion. It's also important to note that U.S. citizen spouses can elect to split gifts when filing jointly, which allows them to double the annual exclusion amount. However, this option is not available when the recipient is a non-resident alien. This limitation can complicate gift planning for couples with one non-U.S. citizen spouse. Certain gifts are not taxable, including those that do not exceed the annual exclusion amounts, payments made directly for tuition or medical expenses, gifts to political organizations, and gifts to qualifying U.S. charities, as long as they are used within the U.S. For those in elder law and estate planning, understanding these rules is essential. Proper planning can help minimize gift tax exposure by structuring gifts within the exclusion limits and considering the type of property being transferred. For instance, gifting intangible assets may avoid U.S. gift tax for non-resident non-citizens, while tangible U.S. property gifts requiring careful evaluation. Clients should also be aware that gifts exceeding exclusion amounts trigger filing obligations and potential tax liabilities. Timely and accurate reporting is key to avoiding penalties. Non-U.S. citizens face specific U.S. gift tax rules that focus mainly on U.S.-situated tangible property, with special annual exclusions for gifts to non-citizen spouses and mandatory filing requirements for taxable gifts.